Is this tech giant, a wildly undervalued AI powerhouse that's just primed for a breakout? Or is this recent massive 12% rally a really dangerous trap waiting to catch retail traders?
I mean, at $240 a share, Amazon looks absolutely dominant on the surface. But, well, beneath that, they are making this historic $200 billion gamble that is just completely destroying their free cash flow today. And they're doing it in exchange for this futuristic vision of tomorrow.
Yeah, so today is April 14th, 2026, and we are looking at the raw financial data to figure out exactly what is going on with Amazon.com Inc., ticker symbol AMZN.
Right, because the stock is sitting at $240.99. It just closed out a 1.09% gain for the session, which, sounds pretty standard.
It sounds like a normal Tuesday, yeah.
Yeah.
But it comes right on the heels of that massive 12% rally over just the past week. So our mission today, for you listening, is to take this massive stack of fresh market data, the technical indicators, financial statements, and insider trading logs, and just cut right through all the noise.
We're going straight into the bull and the bear cases today. We want to track where the smart money is actually going and explain the real mechanics of this surge.
And just so we are completely clear up front before we get into it, we are analyzing the source material to provide an educational look at how these market mechanics work. This is absolutely not financial advice.
Yeah, no, definitely not. We are just dissecting the anatomy of a massive market move. Knowledge and understanding of the underlying machinery is the only goal here.
Right. So let's start with the actual engine driving this company. Because to understand if this current stock price of $240 is justified, we have to look at the income statement.
We had to pop the hood.
Exactly. And the top line revenue number is sitting at $716.92 billion, which is, it's a number so large it almost loses its meaning.
It really does. It helps to kind of break it down. Their net income sits at $77.67 billion. And to put that top-line growth in perspective, their first quarter 2026 guidance, they're expecting an 11 to 15% year-over-year growth.
Wait, 11 to 15% on a number that big?
Yeah. That means they're projecting somewhere between 173.5 and 178.5 billion for this quarter alone.
Wow.
They're effectively adding the total annual revenue of a massive Fortune 500 company to their ledger every 3 months.
That's insane. And looking at profitability, the trailing earnings per share is $7.17 with a forward PE, so price to earnings ratio of 33.44.
Right, the PE ratio.
Now, if we were looking at, say, a traditional manufacturing company or a bank, a PE over 30 would be considered highly elevated, right?
Oh, absolutely. It means investors are paying $33 for every $1 of future earnings.
But the market has historically given Amazon a pass on that high valuation. They carry this growth premium because they have a track record of continuously expanding into entirely new sectors.
Yeah, the market tolerates the high PE because they assume the earnings will aggressively catch up to the price.
Right.
But, and this is where the plot thickens considerably, when we move from the income statement over to the balance sheet and the cash flow statement, Amazon's trailing 12-month free cash flow has just plummeted.
Yeah, I saw that.
It dropped all the way down to $11.2 billion.
Which is really the core friction point of this entire deep dive. Because for a company bringing in over $700 billion in revenue, having only $11 billion in free cash flow is surprisingly low. So the obvious question is, where is all that cash actually going?
It is going directly into property and equipment. The data shows $50.7 billion in trailing capital expenditures.
$50 billion.
And that is just the beginning. Amazon just announced a $200 billion capital expenditure plan for 2026.
$200 billion in 1 year. We really need to unpack how a company even spends that much money.
Right, because it requires a massive shift in infrastructure. The spending is heavily focused on next-generation technology. We're talking about, custom AI chips.
The expensive stuff.
Very. And a massive physical expansion of AWS Amazon Web Services data centers to actually house those chips. Then there are these advanced robotics being deployed across all their fulfillment centers to automate logistics.
Oh, and Project Kuiper, right.
Yes, Project Kuiper, which is their low Earth orbit satellite initiative designed to provide global broadband internet.
I want to look at the mechanism of that kind of spending for a second, because it completely changes how you have to view the stock's value today.
How so?
Well, it's like having a friend who, just got a huge promotion at work, but they immediately take out a second mortgage to build a literal spaceship in their backyard.
That's a great way to put it.
Right. Like, yes, maybe they'll be the first person on Mars next decade.
Hmm.
But today, their bank account is completely drained. The construction bills are astronomical. And you're just wondering, are they a visionary or are they just getting way ahead of themselves?
Exactly. The tension there is between short-term cash flow and long-term asset building. When a company spends $200 billion on AI chips and satellites, it just decimates their free cash flow in the present.
Right. It puts heavy pressure on those current profit margins.
But from an accounting and business strategy perspective, they aren't just, setting that cash on fire. They are converting it into massive, tangible, revenue-generating assets for the future.
Because AWS provides the compute power that other companies use to build their own AI models.
Exactly. And to sell that compute power, Amazon first has to buy the incredibly expensive hardware.
So the fundamental question the market is wrestling with is whether the return on that futuristic spaceship they're building will actually justify the upfront cost.
Which requires patience.
A lot of patience from investors. But if there's one thing retail traders looking at a stock chart right now do not have, it's patience.
No, they definitely don't.
They are looking at the immediate trend line. So let's look at the charts, because the technical indicators are flashing some deeply mixed signals right now.
Yeah, they really are. Amazon's 52-week range is 165.29 at the low end and 258.60 at the high end. Sitting at 240.99 today, it is undeniably in a strong, bullish short-term trend.
Okay.
It's trading comfortably above its 50-day moving average of 222.84 and its 200-day moving average of 213.35.
Can you just briefly explain why those moving averages actually matter to someone tracking this stock?
Sure. So institutional algorithms and traders use moving averages to sort of smooth out the daily noise of stock prices and find the actual trend. The 50-day shows the recent momentum, and the 200-day shows the long-term health.
Got it.
So when a stock's current price is trading above both of those lines, it signals to the broader market that the buyers are consistently in control.
Right. And we are also seeing heavy order flow activity forming new support and resistance levels. For a while, the 238 to 240 level acted as the ceiling or resistance.
Right, the ceiling.
Yeah, every time the stock hit that price, people who bought in earlier would sell to take their profits, and that selling pressure would push the price back down. But over the last week, the stock broke through that ceiling. So now we are seeing that old ceiling being tested as a new floor.
The old resistance becomes the new support, and if that 238 floor breaks and the stock starts falling, the technical charts show the next key levels of buyer support are sitting lower down at 219.36 and then at the major psychological level of 200 flat.
Interesting. So I'm looking at the momentum indicators in the source material, specifically the MCD, the moving average convergence, divergence.
Right.
It's currently sitting at 4.700. What is that actually measuring, and, well, why does that number tell us the bullish momentum is strong?
So the MACD is a tool that looks at short-term price momentum versus long-term momentum. It basically calculates the relationship between two different moving averages.
Okay, comparing the two.
And right now, the short-term trend of Amazon's stock is pulling away from its long-term historical trend so fast that it's creating this massive measurable gap.
Wow.
Yeah, that 4.700 Henner reading shows us that the buying pressure over the last few days has been exceptionally aggressive compared to the stock's usual behavior.
But that aggressive buying is exactly what leads us to the flashing red light on the dashboard.
The RSI.
Yes, the Relative Strength Index. It's currently sitting between 74.03 and 78.81, depending on the specific time frame you pull.
And that's critical because the RSI is an oscillator that measures the speed and magnitude of recent price changes, operating on a scale from 0 to 100. Any number over 70 explicitly flags the stock as overbought.
Okay, I want to push back on this current 12% rally then. Because if an RSI over 70 means the stock is overbought, it means the buying velocity has outpaced the actual underlying business fundamentals.
Right.
It's usually driven by pure greed. So isn't this the exact moment where retail traders fall into a trap? I mean, they log into their brokerage app, they see Amazon is up 12% for the week with a vertical green line, they jump in out of FOMO, and then they get crushed.
That is the classic retail trader trap, absolutely. The mechanics of the market dictate that a stock just cannot go straight up forever without taking a breath.
It has to pull back.
Exactly. Seasoned traders and institutional algorithms look at an RSI approaching 80, and they do the exact opposite of the retail trader experiencing FOMO. They start planning their exits or they trim their positions to lock in profits.
Because they know the pullback is coming.
Yeah, they know that an elastic band stretched that tight is highly vulnerable to just snapping back to the mean.
So even if the company's long-term trajectory is positive, jumping in at an RSI of 78 exposes you to a sudden 5 or 10% pullback simply because the technical indicators need to cool off.
The downside risk of short-term volatility is really significant here. Retail investors often assume that a rising price validates their decision to buy. But buying an overbought stock means you are absorbing all the risk that the early buyers are trying to offload.
Wow. And if retail traders are at serious risk of falling into a momentum trap at these overbought levels, we have to look at what the smart money and the corporate insiders are actually doing.
This is where it gets really interesting.
It is, because this is where the financial data gets fascinating. The analysts, the institutional models, and the corporate insiders are taking completely opposite action.
Yeah, they are totally disjointed.
Let's look at Wall Street first. The analyst consensus is overwhelmingly bullish. Out of 64 analysts covering Amazon, there are currently 0 sell ratings. It is a universal strong buy.
Seeing 0 sell ratings out of a pool of 64 analysts is incredibly rare for a mega-cap stock. The average price target from these analysts is 281.27, and the most optimistic estimates reach all the way up to $360.
But how are they justifying price targets up to $360 when the stock is currently trading at $240 and spending $200 billion on new infrastructure?
The answer lies in the valuation models.
Right. So Investing Pro sets the stock's fair value at $251.91. But when financial institutions run a discounted cash flow model, a DCF model, it suggests the intrinsic value of Amazon is actually $350.61.
Which is a huge jump.
It is. Explain how that math works. How does spending massive amounts of capital make the stock worth more?
Well, a discounted cash flow model doesn't look at today's bank account or today's free cash flow drop. It is a mathematical projection.
Okay.
Analysts estimate all the future cash those new AI data centers, satellites, and automated warehouses will generate over their entire lifetime. Then they apply a discount rate to account for the time value of money and the risk involved, bringing all that future wealth into today's dollars.
I see.
So by that forward-looking math, the $240 price tag today represents a massive 33% discount compared to what the company will theoretically be worth once those investments mature.
I understand the theory, but I have a major problem with how that aligns with reality.
Let's hear it.
If the fundamental DCF models say the stock is deeply undervalued at a 33% discount, and Wall Street is universally screaming strong buy, why are the top insiders selling off millions of dollars of their own stock?
That is the big question.
Right. In early 2026, CEO Andy Jassy sold $4.1 million worth of shares. Other top officers like Douglas Harrington and David Zapolsky have also sold millions throughout the first quarter. If the stock is intrinsically worth $350, why is the CEO cashing out at $240?
It is one of the most heavily scrutinized dynamics in market analysis. Insider buying is almost universally a signal that management believes the stock is undervalued and going up. But the mechanism behind insider selling is much more complicated.
How so?
Well, executives receive a massive portion of their compensation in restricted stock units. When those units vest, they owe enormous taxes on them.
Oh, so they sell shares just to pay the tax bill on the shares they just received.
Exactly. And furthermore, executives often set up what are called 10b5-1 trading plans.
The automated ones.
Right. These are automated pre-scheduled sell orders set months or years in advance to avoid any legal accusations of trading on insider information. They sell to diversify their personal wealth so their entire net worth isn't tied up in the single company they work for.
However, context is everything, right? Even knowing that they sell for taxes or diversification, when you see a cluster of top executives all selling in the same quarter, right as the technical RSI is flashing overbought, it kind of changes the narrative.
It definitely raises eyebrows.
It tells you that management isn't necessarily viewing this specific 240 price point as a generational buying opportunity for their own personal portfolios.
Yeah.
I mean, if they genuinely believed a massive imminent jump to 350 was guaranteed, they might restructure their diversification plans to hold a little longer.
Yeah, it is a critical data point that careful investors weigh against the analyst models.
And it contrasts heavily with what we're seeing from the major institutional players and the political sphere.
Yes, it does.
Looking at the required financial disclosures, institutional ownership remains massive, sitting at 72.2%. The big funds are holding tight. And we also see recent purchases by U.S. congressional members, including Ro Khanna and Nancy Pelosi.
Yeah, and looking at that strictly as a market data point, completely independent of any political perspective, institutional algorithms track these congressional trades closely.
Right, because of their access.
Exactly. Lawmakers have high-level visibility into broader economic policy, regulatory shifts, and trade relations. When they take long positions in a company, the market logs that as a metric of confidence in the stock's future trajectory.
So let's recap this contradiction. Wall Street models show a 33% intrinsic discount. Major institutions and politicians are holding or buying. Meanwhile, the CEO and top officers are quietly taking millions of dollars in chips off the table during an overbought technical rally.
It's a tug of war.
It really is. And that massive contradiction perfectly frames the ultimate debate. So let's look at the two opposing scenarios for the stock's future, the bull versus the bear case.
We can start with the bull case. This is the best-case recovery scenario where Amazon's current momentum is fully justified, and they shatter their previous 52-week high of 258.60 on their way to those 300-plus price targets.
And the entire optimistic outlook rests on two structural pillars, right? Advertising and AWS.
Primarily, yes.
Amazon's advertising growth is currently up 22%. They have leveraged their retail platform to build one of the most profitable, high-margin digital ad networks on the planet. But the real driver is AWS, their cloud computing division.
Because AWS is where the AI lives.
Exactly. The bull case assumes that the $200 billion capital expenditure is not a gamble, but a necessary cost to maintain an absolute monopoly on AI infrastructure. If they provide the literal servers, the custom chips, and the data centers that every other company uses to run their AI applications, then short-term cash flow simply does not matter. The future revenue streams will be astronomical.
It is a really compelling thesis, but the bear case, the worst-case continuation lower, focuses on the very real friction of that spending. The primary risk centers on margin compression.
Break that down for us. Explain how that compresses the margins.
Well, a $200 billion Capex plan carries immense depreciation costs and operational expenses. If the global monetization of AI doesn't happen as rapidly as Wall Street expects, Amazon will be sitting on billions of dollars of expensive, depreciating hardware without the corresponding revenue to offset it.
Ouch.
Yeah, their free cash flow will continue to shrink, their profit margins will compress, and institutional investors will punish the stock price for reckless overexpenditure.
And there are also massive macro risks outside of Amazon's direct control.
Right.
The data shows signs of slowing international retail growth. But the larger threat comes from regulatory pressures regarding U.S. trade policy. The potential for heavy tariffs on Chinese-sourced inventory remains a major headwind.
The mechanism there is pretty straightforward. Amazon's e-commerce dominance relies heavily on third-party sellers sourcing cheap goods from overseas. If heavy tariffs are enacted, it drastically increases the cost of those goods. Amazon either has to absorb that cost, which destroys their retail profit margins, or pass the cost on to the consumer, which lowers overall sales volume as inflation-weary shoppers just buy less.
So the timeline of your investment drastically changes how you view these two competing cases. If I'm trading options that expire next month, my risk profile is entirely different than someone holding the stock for their 2030 retirement portfolio.
Completely. The short-term and long-term outlooks are practically looking at two different companies. In the short term, over the next few weeks, everything hinges on the upcoming April 30, 2026 earnings report.
Right. The market wants results.
They are going to demand immediate proof that the strategy is working. They want to see that current AWS AI revenue is growing fast enough right now to justify the massive capital expenditure.
And if that April 30th report shows weak cloud growth,
then the overbought RSI we discussed earlier will act like gravity. The buyers will vanish, the early investors will sell to protect their profits, and the stock will likely face a sharp correction back down to those lower support levels.
But what about the long-term view?
Looking ahead to the end of the decade, the outlook relies entirely on the execution of that $200 billion bet. If Project Kuiper successfully challenges for global satellite internet dominance and their custom AI chips become the industry standard over competitors, today's elevated price of $240 will eventually look like an unbelievable bargain.
So let's distill these takeaways for you as you evaluate this data. We are looking at a behemoth of a company with fortress-like revenue pushing past $700 billion. They have uniform Wall Street buy signals and a discounted intrinsic value model that suggests a massive upside.
But on the flip side,
they are in the middle of an undeniably overbought technical rally driven by short-term momentum. So anyone analyzing this stock has to weigh that 33% intrinsic value discount against the reality of the situation.
Right, the margins.
Yes, they are facing the immediate margin crush of a $200 billion spending plan, the macro risks of inventory tariffs, and the undeniable fact that top insiders are quietly selling off millions of dollars of their own shares.
It is a live-fire example of how competing forces operate in the market. You have fundamental intrinsic value competing against technical overbought signals. You have institutional confidence competing against insider selling.
And whether you are managing your own tech portfolio, tracking the global AI infrastructure race, or just trying to understand how massive corporate spending impacts the psychology of the market, Amazon is the perfect case study. It forces you to look past the ticker price and examine the underlying mechanics of corporate finance.
It really does. It ultimately comes down to whether you believe the company's vision of the future is accurate enough to justify the cost of building it today.
Which brings us back to that massive spaceship they are building in the backyard while their current cash flow drops. We started this deep dive by asking if this was an undervalued AI powerhouse or a dangerous FOMO trap for retail traders. But the source material leaves us with a much larger question.
That's that.
Well, think about the conviction required for a company's leadership to voluntarily tank their own free cash flow to place a $200 billion bet on a futuristic infrastructure of custom AI chips, advanced robotics, and low Earth orbit satellites.
It's a massive risk.
It is. It's a bet that won't fully materialize until the year 2030. So what exactly do they see coming in the future of global commerce and artificial intelligence that the rest of the market hasn't even begun to price in yet?